The world economy faced a series of dangerous events during the first week of 2016. Global markets witnessed their worst openings in more than 30 years. Trading in Chinese stocks was suspended twice, the price of oil fell to its lowest in 12 years, and the World Bank warned that a perfect storm might be on its way. In addition to $2 trillion of outflow from global stock markets, political tension rose between Saudi Arabia and Iran, and North Korea claimed to have tested a hydrogen bomb. Billionaire investor George Soros says these events remind him of the triggers of the 2008 financial crisis. I would say it amounts to a crisis. When I look at the financial markets, there is a serious challenge which reminds me of the crisis we had in 2008. But is 2016 going to be the year when the world falls back into crisis? Ish Investment International Capital Markets Manager Shant Manoukian doesn't agree with Soros. He says there are risks, but recent events won't evolve into a financial meltdown.
I don't think that we are looking at 2008 crisis, but of course there is a tail risk about 10% of a huge yuan devaluation, which might affect some other countries, emerging markets, and then that could hit the financial markets.
Crashing Chinese stocks and tumbling oil prices have been the main source of concern since the new year began. But why? Because of its high growth rate, China is known to be the locomotive of global growth. According to IMF data, its contribution to the global economy was 16.6% in 2014. So, a slowdown in the Chinese economy hurts countries which need it as a major export destination. However, recent data reveals that the world's second largest economy is significantly cooling down. The People's Bank of China took various steps to prevent a hard landing, but couldn't avert panic in global markets. Shant Manoukian says investors used to believe the Chinese central bank had a firm grip on the exchange rate, but it became obvious that even the bank couldn't control the offshore rates.
There is a huge outflow from China. So people are getting more worried. There is a sense of the government and Bank of China is losing control. So before everybody else heads to the door, we should leave the building.
Since China is the world's biggest consumer of many commodities, the slowdown in its economy has caused prices to plummet, especially triggered by concerns over China and the strong dollar. Oil fell around 18% this year alone. Brent crude even slid below $30 a barrel for the first time since December 2003. Low commodity prices put pressure on producer countries. Russia and Brazil are in recession, while Saudi Arabia has announced a list of austerity measures. Renowned economist Professor Steve Hanke says that because of all this, 2016 is not going to be an easy year.
It's going to be a volatile year because some headwinds in China, headwinds in commodity-producing countries, huge headwinds and uncertainty in all the Middle East region and North Africa. Europe is in considerable trouble.
But Professor Hanke believes that despite its slow pace, the stability of the US economy will help the situation.
The only spot where you really don't have so many headwinds are the United States. And even there, we're still in a growth recession. In the land of the blind, the one-eyed is king, and the one-eyed is the US.
What happens if the events of the first week of 2016 aren't temporary? More monetary easing? More interest rates below zero? Nobody really knows, so buckle up. 2016 looks like being another tough year.